Well, Jason and Cillein, the two of you lead a group of professionals from all around the world, helping our clients figure out issues related to capital management and treasury. And certainly, if the last 18 months of COVID taught people anything, it's just that capital management is super important. Jason, I'd be interested in getting your perspectives on what people are focused on today.
Thanks, Rodney. As far as financing trends from a U.S. tax perspective, despite all of the adoption of recent rules designed to limit a U.S. group's ability to benefit from current interest expense deductions, including rules such as the base erosion and anti-abuse tax, or BEAT as it's known, or even the 385 recast rules, as well as the U.S. adopting anti-hybrid rules. Clients continue to use internal leverage to finance U.S. acquisitions, as well as to fund their U.S. operations' day-to-day working capital needs. From a treasury perspective, to the extent there's a cash need in the U.S., an offshore treasury center is going to prefer to lend money into the U.S. since the repayment of principal is not taxable, and principal can be repaid without the corporate issuer's board of directors needing to take corporate action, as is the case when a corporation wants to declare and pay a dividend to its U.S. shareholders. More recently, I think both U.S. and non-U.S. groups are monitoring the U.S. legislative environment carefully, as there's multiple legislative proposals to modify or even replace some of the existing rules, including the BEAT rules, and potentially to adopt another interest expense limitation rule that would essentially require a U.S. group's interest expense deduction be limited to a portion of its financial reporting group's overall net interest expense, and you would look to the U.S. group's EBITDA to the financial reporting group's EBITDA to determine how much interest expense is deductible in the U.S. The other thing from a Capitol Hill Watch perspective is taxpayers continue to monitor whether Congress may consider making a taxpayer favorable change to our current 163J rules, which are often referred to as our earnings stripping rules. More specifically, today, interest expense deductibility under 163J is limited to 30% of adjusted taxable income. Through the 2021 tax year, adjusted taxable income is defined very similarly to EBITDA. However, beginning in 2022, adjusted taxable income will be based off EBIT, which means corporate taxpayers won't be able to add back depreciation and amortization and depletion deductions. And so this could have a pretty limiting effect on the amount of interest expense deductibility in 2022 and thereafter. So that continues to be a hot topic that is being monitored. So that really wraps up where we are from a U.S. perspective.
So that's really interesting, Jason, because I guess it's very easy to forget with all these rule changes and the new proposals this year, the fact that actually the deductibility of interest expense is scheduled to change anyway, starting in 2022. And I assume people are modeling that out just to understand exactly what that means for them. So that's
it's got a pretty negative effect for a lot of the manufacturing groups. So definitely it's top of the list.
So that's a good point. And of course, your point also about the fact that debt is still a very preferred option just because of the simplicity and ease of moving cash around. So we always tend to focus in on the tax stuff first, but actually that stuff in many ways is more important to Treasury folk. So Cillein, I just wonder, how are those thoughts that Jason shared, how are they consistent or different to what you're seeing over in Ireland and Europe?
Yeah, hi Rodney, greetings from Dublin. What I would say is financing will always remain an important topic for groups. Groups will need to manage cash, manage FX, liquidity management around accounts payable, accounts receivable, and then of course the fund M&A activity and business expansion. And in a continuing environment of low borrowing costs, I think we'll see and continue to see the use of debt in all those aspects. It doesn't make sense, I think, for anyone to fully equity fund group companies. That's just not commercial. These are all business needs, Rodney, I think, that drive these decisions. But of course, tax is an important and very important consideration to ensure that these are efficient as possible. What I would say is the tax, similar to what Jason touched on, the tax rules are certainly becoming more complex. Look at this from a European perspective. Under the European Anti-Tax Avoidance Directive, we've had a couple of key changes. We've had the anti-hybrid rules that have been introduced now all over Europe, and particularly in Ireland. That was a new concept for us. We also had the interest limitation rules, which are based on a percentage of EBITDA. And in Ireland, we've been introducing those rules from next year onwards, which would look like a 30% of EBITDA restriction. So they've been kind of two fundamental changes that have impacted at a European level. I think we've also got changes at OECD level through the transfer pricing guidelines, where debt capacity assessments are now quite important and also impact on this whole process as well. So a lot going on in this space, as I mentioned, certainly become more complex from a tax perspective. But given the importance of financing and treasury for groups, these tax issues have to be managed and will continue to have to be managed. I mean, one last point I'd mention on the Irish side, Rodney, is I've certainly seen a lot of groups exploring Ireland as their home for treasury operations. There's been a long history of groups who have done that, and a lot of available talent here. And that's certainly something I've seen an uptake in interest in recent times.
Well, that's interesting, because I suppose, I suppose the reason that you have this global team is there must be a great intersection between, what you've been talking about, Cillein, which is just a myriad of issues at the European and European country domestic level, ATAD, EBITDA limitations and whatnot, and also what Jason was talking about in terms of the US tax reform rules. And I'm guessing the intersection of those two must cause treasury groups a lot to have to consider and model out.
Yeah, certainly, Rodney. There's a lot of complexity, a lot of different rules, and it's a lot of changes to rules. And then you build in things like withholding taxes as well under each of the various treaties. So you do need to give a lot of consideration on a jurisdiction by jurisdiction basis when designing and implementing any type of treasury activity. So certainly the tax team will always play a key role working side by side with their treasury colleagues when looking at any group financing transactions.
Well, just fascinating to both of you. This is clearly just an area where there's just continual law change, it feels, and very hard to keep on top of. So I want to thank you both for your time today, and look forward to catching up again when there's yet another series of proposals that people are talking about. So have a good day, both.